All right, let's jump right into it. Welcome to today's explainer on the Destiny Tech100 Fund, ticker symbol DXYZ. Now, this is an absolutely fascinating case study in modern investing, because on one hand, it offers this unprecedented access to some of the most exciting, world-changing private companies out there. But on the other hand, it harbors some serious hidden financial risks. Today, we're going to examine exactly how this fund works, and we are going to focus intensely on the very real dangers of investing in a fund that trades at a massive premium to its actual assets. Get ready, because the volatility that comes with this structure is completely wild.
We have a lot of ground to cover, so here's the game plan. We'll kick things off with a pre-IPO check dream, then look under the hood at CEF mechanics. After that, we'll break down the price versus NAV gap, ride the volatility roller coaster, dig into the fresh NAV debate, and wrap up with our final verdict on premiums. Let's get going.
Section 1. The Pre-IPO Tech Dream. Let's see how DXYZ is attempting to democratize venture capital.
For decades, everyday retail investors have run into this incredibly frustrating problem. You historically just couldn't buy into private explosive tech companies before they went public. All that incredible early-stage growth totally locked away behind closed doors, reserved for huge institutional venture capital firms and ultra-wealthy insiders. By the time a company actually had its IPO, a massive chunk of the wealth creation had already happened. But DXYZ changes the game. Their goal is to build a portfolio of 100 top venture-backed companies, and the roster they've assembled so far is packed with absolute heavyweights. We're talking SpaceX, making up roughly 16% of the portfolio. You've got AI giant Anthropic at 18%, plus OpenAI, Databricks, Stripe, and Elon Musk's xAI. It's an absolutely stacked, curated basket spanning the cutting edge of AI, aerospace, and fintech.
And their own stated mission brilliantly captures why people are so excited about this. It's about democratizing access of pre-IPO tech giants that have historically been available only to institutional venture investors. It's a genuinely novel concept. It literally gives regular folks a seat at the billionaire's table. Anyone with a standard brokerage account can suddenly buy a stake in the private infrastructure of tomorrow. It sounds like an absolute dream, doesn't it?
Well, we need to talk about Section 2, Under the Hood, CEF Mechanics. Because the structural reality of how this access is packaged is where the danger actually lives.
To truly understand what you're buying with DYZ, you have to understand the wrapper it comes in. Most of us know ETFs, or exchange-traded funds. An ETF continuously creates and redeems shares to make sure its stock price stays closely matched to the actual real-world value of the assets it holds. But here's the catch. DYZ is not an ETF. It's a closed-end fund, and a closed-end fund issues a fixed number of shares. It doesn't continuously balance things out behind the scenes. So what does that mean for you? It means the share price is driven entirely by market supply and demand, completely independent of what the underlying assets are actually worth. The price you pay on the open market can totally disconnect from the fundamental value of the companies inside.
This brings us to a concept you absolutely have to know: NAV, or net asset value. This is the true underlying value of a fund's portfolio of assets minus its liabilities divided by the number of outstanding shares. Basically, this is the official accounting of what those shares in SpaceX and OpenAI are literally worth on paper. Ideally, when you buy a fund, you want the share price to be as close to this NAV as possible.
Which leads us perfectly into Section 3, the price versus NAV gap. It's time to mine the premium. Let's look at what happens when retail hype collides with a fixed supply of shares.
The data tells a crazy story. You have a market share price of $34.70, while the official net asset value sits at just $19.97. That creates a massive 92% premium. Because access to these specific private companies are so incredibly rare, and the hype around AI and space is through the roof, investors are paying almost double the official value for these assets. The market is demanding this huge premium just for the privilege of holding these companies in a publicly traded wrapper.
And no joke, it gets even wilder. Let this number sink in for a second. The 52-week average premium was a staggering 235%. That means, on average, over a whole year, people were literally paying more than triple the actual stated value of the underlying holdings. If the assets inside were worth $10, people were happily shelling out over $33 just to own the stock. Understanding this gap is absolutely crucial. It's the single biggest risk factor for this fund.
Let's use a quick analogy to make the math brutally clear. It's like paying $54 for a wallet when you know for a fact that officially there's only a $20 bill inside it. You are paying a $34 premium just to hold that specific wallet. You have to really believe that the 20 bucks inside is going to grow incredibly fast to justify that extra money you spent. If it doesn't, you've just wildly overpaid.
And that takes us to Section 4, the volatility roller coaster. Let's talk about riding the hype cycle, because this massive premium turns DXYZ into an entirely different beast than a regular stock.
That huge gap between share price and NAV is an engine for insane volatility. Think about it. How does a stock price swing nearly 4 times in a single year, jumping from under 20 bucks to over $72? Did the private companies inside, SpaceX, Databricks, did they magically quadruple their actual enterprise value in a few months? No way. So what actually caused that massive swing?
Well, it's because you aren't just trading the companies, you are trading the sentiment cycle of the premium itself. Step 1. The hype ramps up. Maybe there is a big rumor about a SpaceX IPO or crazy news in the AI space. Step 2. Retail investors rush in, and because those shares are scarce, the premium expands rapidly, pushing the stock price to the moon. But then, step 3, the news cycle inevitably cools down, and step 4, the premium compresses. When that premium shrinks back toward the actual NAV, the stock price crashes much faster than any change in the real value of the companies. You are literally riding the expansion and violent compression of the premium.
And because that premium gets so absurdly high, it attracts a very specific type of market dynamic. About 17% of the stock's float is heavily shorted. That means you've got sophisticated, institutional investors actively betting against the stock, just waiting for the hype to die so the premium compresses. But here's the kicker. That high short interest creates its own volatility. If the stock suddenly spikes, those short sellers panic and are forced to buy shares to cover their positions, which triggers a wild short squeeze. We've actually seen this dynamic cause a 22% jump in a single day with zero fundamental news. It is for sure a trader's market.
Moving on to Section 5, the fresh NAV debate. Speculation in the dark. To complicate everything even further, the official NAV for these funds is usually only updated quarterly. But in AI and aerospace, valuations change overnight. This creates a massive information vacuum, and retail investors, they try to fill that gap themselves.
There is a huge debate raging online right now. On one side, you have the official SEC reported NAV of $19.97. This is trailing data. It's slow, highly regulated, and accounts for all the fund's fees and liabilities. On the other side, you've got folks on Reddit using AI to estimate a so-called fresh NAV of over $62, just by guessing multipliers based on recent private funding rounds. Based on this highly speculative math, traders are convincing themselves that the fund is actually a massive bargain, even when it's trading at a massive premium to the official numbers.
But, there are some glaring blind spots in that speculative Reddit math. First off, it almost always ignores the fund's steep 4.5% total expense ratio, which eats directly into your returns. Second, DXYZ doesn't always hold direct equity. They often use complex special-purpose vehicles, or SPVs, which carry their own underlying discounts and risks. Third, the fund issues new shares to raise capital, which means ongoing dilution for existing investors. And finally, a valuation on paper absolutely does not equal cold hard cash until a liquidity event, like an actual IPO, happens.
All right, let's bring it home with Section 6, the final verdict on premiums. 2 bets in 1. Because investing in a closed-end fund that trades at a massive premium requires a totally different risk calculation than buying a standard stock.
You have to realize that you are actually making 2 simultaneous bets here. Bet number 1 is that the underlying tech companies will continue to dominate, innovate, and grow. But bet number 2 is purely psychological. You are betting that the stock market will willingly sustain a massive premium just for the wrapper holding them. And the warning here is stark. If AI hype cools off, or if those highly anticipated IPOs get delayed, that premium is going to compress. And premium compression is incredibly painful, driving your investment down sharply even if the companies themselves are doing just fine.
So, as you look at these incredibly exciting, unprecedented opportunities to tap into private venture capital, you really have to ask yourself one critical question. Are you actually paying for the underlying innovation, or are you just paying a massive premium for the hype of the wrapper? It's a vital distinction you have to make before putting your hard-earned money on the line. Thanks so much for joining me for today's Explainer. I hope it helps you evaluate your next big investment opportunity with a much sharper eye. Catch you next time.